I'm Steve Cicala, and I'm an assistant professor at the Harris School of Public Policy at the University of Chicago. Today I'm presenting my paper on U.S. electricity markets, where historically the sector was sort of broken into individual fiefdoms where utility engineers were in charge of deciding which power plants were going to turn on and off over the course of the day in order to keep the lights on. And there's been a transition over the past 20-25 years towards using auctions and using markets to make those decisions. So the tension here is between, on one hand, the regulated utilities not having very strong incentives to coordinate their operations across areas, and maybe not have the strongest incentives to make sure that their most economical power plants were always operating. The tension trading off against the potential exercise of market power in electricity markets. And so I have put together the hourly data of virtually every generating plant in the United States over a 14-year period, and use the staggered introduction of electricity markets over time in order to evaluate the impact that these markets have had on costs. So I find that when these areas start using markets to determine which power plants operate, there's a pretty big increase in the flows of electricity between these areas. So they start coordinating their operations better. The concern about market power, actually on net, the introduction of markets ensures that more economical power plants are available to operate at any moment in time, so that the net impact in just the very short run, trying to keep the capital stock of which power plants could actually operate fixed, has reduced costs by $3 to $5 billion per year in the United States.